Pay attention. 9 trading days until first notice day. 59,000 contracts still wide open. That represents 294 million ounces of paper silver sitting there, waiting, breathing. Everyone keeps saying this will naturally roll off, that any minute now the usual price destruction will finally show up. Strange how that hasn't fully materialized yet, even with the perfect manipulation window sitting right in front of them. Today, President's Day bank holiday shuts down U.S. markets completely. Shanghai closed until February 24th for Lunar New Year celebrations. The banks just got handed breathing room on a silver platter, an 8-day window where the rules bend differently, where liquidity vanishes, where nobody's watching closely enough. If this is your first time hearing this, I'm guessing you clicked with serious doubt pumping through your mind. Honestly, that's the correct response. Don't trust anyone outright, definitely not strangers on the internet, not even me. What becomes clear over time is the people who actually stay aren't the ones who blindly believe whatever gets thrown at them. They're the ones who came in skeptical, actually went through the effort of verifying the sources themselves, cross-checked the data against official records, and discovered that everything checks out exactly as presented. The establishment, the mainstream banking cartels, the corporate media apparatus, the entire corrupted infrastructure profits directly from keeping you uninformed and confused. They don't want you cross-checking information because verification destroys their narrative control. So if you're new here, let me clarify something immediately. I don't sell anything. No courses, no exclusive memberships, no trading signals, nothing packaged and monetized. This is financial warfare education, not financial advice wrapped in marketing funnels. Mathematical certainty, not opinion. Pattern recognition. What I'm about to show you has happened exactly 3 times in recorded history, and each time it destroyed empires that thought they were permanent. Same pattern, same sequence, same outcome. The Roman Empire, peak of civilization, military dominance across 3 continents, currency accepted everywhere from Britain to Mesopotamia. Then the debasement began, slowly at first, then accelerating. Silver content in the denarius dropped from pure silver to 50%, then 25%, then barely a coating. Soldiers demanded payment in gold because paper promises and debased coins bought nothing. The empire collapsed not from barbarian invasions, but from currency destruction that made maintaining armies mathematically impossible. Verified. The Dutch Empire, 17th century global superpower, Amsterdam the financial capital of the known world, the guilder the reserve currency for international trade. Then came the wars, endless expensive conflicts draining the treasury, debt piling upon debt, money printing to cover obligations that real productivity couldn't support. By the time the Fourth Anglo-Dutch War finished, the financial system was hollow, Britain took over as the new financial center, and Dutch dominance evaporated within a generation. Verified. The British Empire, the sun never sets, controlling a quarter of Earth's landmass, the pound sterling backing global commerce for over a century. 2 world wars destroyed that foundation completely. Debt exploded beyond any possibility of repayment. America emerged holding the gold reserves. Bretton Woods transferred reserve currency status to the dollar, and Britain spent the next 50 years managing decline while pretending otherwise. Verified. 3 empires. 3 collapses. Same pattern every single time. Currency debasement, unsustainable debt levels, military overextension, rival powers building parallel systems, then the sudden recognition that the old order is finished. The timeline from peak to collapse averaged 50 to 100 years. Not centuries. Not gradual, comfortable transitions. Explosive unwinding once the tipping point hits. This is an ancient history disconnected from current reality. This is the playbook, and we are watching it play out in real time with machine-like precision. Silver Western spot price $76. Futures also $76. Shanghai spot price $86. Shanghai futures $88. That's a $10 premium holding rock solid despite Western consolidation and paper market manipulation. Gold Western spot $4,096, slipping under that 5,000 psychological level that held for weeks. March silver open interest dropped slightly Friday to 58,770 contracts after 43% rolled forward into the May contract like they're supposed to during normal market mechanics. However, with 9 days remaining before first notice day on February 27th, A massive 294 million ounces remains sitting there wide open. If even half of that stands for delivery instead of rolling or closing, the COMEX faces a substantial drawdown against registered inventories of only 90 million ounces. You can't unsee it once you understand the mathematics. Here's what most people completely miss about delivery mechanics because they never bother checking historical data. Analyzing 10 years of COMEX contracts shows gold averaged 9.6% of open interest actually delivered. Silver averaged 4.9%. The latest elevated numbers, showing 13.55%, are extreme outliers, but average behavior clusters closer to 10%. If we use 10% as baseline potential with 20% as the elevated extreme during stressed markets, that represents 29 to 59 million ounces demanded against 90 million registered. Theoretically manageable on paper. But those historical averages were calculated during normal market conditions, not during the sixth consecutive year of structural deficit, with Eastern buyers demanding physical metal at $10 premiums above Western paper prices, showing the paper physical divergence accelerating beyond anything in modern commodity history. Gold $20,000 calls just surged to 11,000 contracts according to official exchange data, showing sophisticated institutional positioning despite the recent sell-off. These far out-of-the-money December call spreads between $15,000 and $20,000 are building substantially even after the historic correction that hammered prices earlier this year. Positioning has grown dramatically despite gold prices consolidating near $5,000. For this spread to expire in the money, gold prices would need to nearly triple by December expiration. Analysts describe this as cheap lottery ticket positioning, sophisticated players betting on asymmetric upside potential, using these extreme strike prices as tail risk protection against potential monetary crisis scenarios where gold could spike dramatically higher than current price action suggests possible. Warren Buffett, in his famous 1998 Harvard speech, called gold a metal with no utility whatsoever. He said it gets dug out of the ground in one location, melted down, transported somewhere else, buried again in another hole, then guarded by people who stand around doing absolutely nothing productive. That was his public criticism at the time, comparing gold unfavorably to productive businesses that generate actual cash flows and economic value. That assessment has aged like milk left in the desert sun. Since 1998, gold has dramatically outperformed the investment vehicle he built and crushed most equity indices as currency debasement accelerated exactly as alternative analysis predicted during Stage 6 debt cycle dynamics. Not opinion. Pattern recognition. Bloomberg headlines during the silver crash reveal a pattern worth examining closely. During the worst sell-offs, Bloomberg published multiple articles emphasizing the declines. Headlines screamed about big drops, no buyers left, crazy swings with almost no liquidity holding markets together. Most stories got published right when prices were falling hardest in early February. Maximum fear, maximum panic. February 12th. Bloomberg ran a story claiming Russia might return to using dollars for international trade. Right after that article hit the wire, silver dropped violently from 85 to 74 in a matter of hours. Many traders noted the headline timing scared retail participants into panic selling. Perfect timing for anyone positioned short against silver who needed forced liquidation to cover. Analysis has documented countless times how large media outlets, often Bloomberg and Reuters specifically, get weaponized to manipulate prices through fake headlines or misleading stories that trigger algorithmic reactions and emotional responses. Chinese fund manager now compensating silver investors after that dramatic 31.5% valuation-driven drop early this month. They unveiled a compensation plan addressing widespread losses from the country's only silver futures fund. The plan targets investors who submitted redemption orders from January 30th afternoon through February 2nd, the exact period when losses were magnified by an extraordinary valuation adjustment mechanism. Investors whose incremental loss beyond the capped 17% drop was under 1,000 yuan will receive full compensation, a group accounting for more than 90% of those who tried redeeming. This situation exposed how the Shanghai Futures Exchange's 17% daily price limits actually impeded the fund's ability to execute exit trades for investors during extreme volatility. Traders believe this situation was known by certain players with advanced information who deliberately gunned for the downside once the revaluation method was unveiled publicly, then profited massively by shorting global silver futures and exploiting the mechanical adjustment that was completely divorced from actual supply-demand reality on the ground. Swiss expert Johann Steger is calling the January 30th crash the biggest $100 billion fraud of all time. According to interview analysis, silver plunged over 30% in one single day from peaks above $120 down to the 70s. It started immediately right after the London fixing at 15:12 Central European Time. Then a $26 drop occurred in just 180 minutes. JP Morgan closed massive short positions exactly at the bottom after they already paid $900 million in fines for silver spoofing violations. The COMEX ignored their own circuit breakers during thin Friday trading volume. Paper contracts traded 1.83 billion ounces that single day. Zero physical metal actually moved anywhere. Shanghai premiums exploded to 40% or higher while COMEX crashed, showing the east-west divide widening into a canyon. China cracked down hard on naked short selling, banned traders permanently, 180 cases still ongoing through their enforcement system. They did what regulators are supposedly paid to do. Asia will set prices going forward as the LBMA and COMEX fade into irrelevance, according to his assessment. He targets silver at $184 by Christmas, possibly $200 to $300 on default scenarios. Physical silver never spoils or degrades. An ounce stays an ounce forever. Buy more on pullbacks. Average down if you're convinced about the thesis. Jim Rogers, co-founder of the Quantum Fund, which gained approximately 4,200% from 1973 to 1980, warns clearly, don't sell your silver, don't sell your gold. He still owns both metals. Hasn't sold any despite massive price appreciation. If prices drop further, he hopes he's smart enough to buy additional physical metal during those pullbacks. He bought recently during the drops. Hopes his children inherit the stack someday. There's a gigantic amount of money printing happening all over the world according to his assessment. Many people are protecting themselves from currency debasement. Historically, that protection always included metals like gold, silver, copper. For a few hundred years, people needed a way to protect accumulated wealth, and that included these specific metals. Historical proof extends back thousands of years. Even biblical references to 30 pieces of silver show metals were prized throughout human civilization as stores of value during currency debasement cycles. Not might happen, will happen. Asian markets open with silver getting knocked down $2 over just a few minutes. Clearly a tactical move designed to scare weak hands, then accumulate inventory at artificially lower prices. But silver recovered quickly as buyers in the Middle East and Europe came online and absorbed everything offered. The COMEX is actually open until noon Eastern Time today. So the bullion banks have a perfect opportunity to smash prices using light holiday volume. Then markets reopen at 6:00 p.m. Eastern tonight. Reports confirm silver is selling out completely in Dubai. Not just social media rumors or anecdotal stories. Wealthy people in the Middle East are sophisticated buyers with professional agents purchasing worldwide. This represents a major force blunting Western bullion bank silver smash attempts because physical absorption prevents sustained downside when Eastern demand remains structurally strong regardless of Western paper price manipulation during the Shanghai closure window. Dollar short positions just hit a 14-year extreme according to the latest sentiment survey. Short bets against the dollar are now the highest since January 2011, the earliest data available in the series. Fund managers' dollar exposure dropped below last April's lows. Concerns about Federal Reserve independence have eased somewhat, but completely failed to lift dollar demand or improve sentiment toward U.S. assets. Respondents cite further deterioration in labor market conditions as the key downside risk. This positioning extreme creates potential for a violent short squeeze if data surprises, or it confirms a structural trend break, depending on whether economic reality validates the bearish thesis or forces mass repositioning when data diverges from consensus, creating mechanical covering pressure. Ray Dalio's analysis of 500 years of historical data showing exactly how empires collapse concludes that America is now in stage 6 of 9 total stages. The dangerous stage. The pattern repeats with machine-like precision every 50 to 100 years, not because of politics or ideology or leadership failures, but because of mathematics. The big debt cycle has 9 distinct stages, and we are currently deep in stage 6, where federal debt exceeds 120% of GDP. There are exactly 2 choices. Let interest rates rise naturally and crash the economy immediately, or print money endlessly and create runaway inflation. Both paths destroy accumulated wealth, just differently. Stage 6 is characterized by slowing productivity growth that can't service debts, debt service costs rising faster than GDP growth. Money supply expanded 40% since 2020 alone, wealth concentration at century-high levels creating social instability, and rival powers building parallel financial infrastructure systematically. We are not at the cliff debating whether to jump. We have already walked off it. The only question remaining is how long the fall lasts before impact. Howard Marks wrote extensively about market cycles, documenting how understanding where you are in the cycle matters infinitely more than predicting exact timing of turning points. Stage 6 doesn't guarantee immediate collapse tomorrow morning, but it absolutely means the probability matrix has shifted dramatically towards stage 7, which is reset through either massive debt restructuring, international negotiation, or outright conflict. History shows wars resolve 90% of these cycles, not because humans are inherently violent, but because debts become mathematically impossible to service when internal inequality peaks and external rivals emerge simultaneously, creating conditions where conflict becomes the least bad option compared to accepting managed decline that's politically and socially unacceptable to populations. China doesn't want to operate inside the U.S. system according to geopolitical analysis. It wants its own financial order with Chinese characteristics. Production prioritized over speculation. Society prioritized over shareholders. Currency strength prioritized over endless debasement. Capital flowing inward, not hollowing out the productive base. The American model prioritized profit maximization above all other considerations. Wall Street won everything. Main Street lost everything. The real economy got sacrificed completely to financial engineering and stock buybacks. China already dominates the physical economy through manufacturing capacity, supply chain control, and trade relationships. Now moving systematically to the next phase, which is financial dominance through commodity backing and parallel payment systems. For the United States, this isn't economic competition. This is existential war. Because America's financial empire is the last line of defense. Lose that, and the entire economic model breaks permanently. This is the Thucydides trap playing out in real time, where a rising power changes the balance, and the dominant power realizes the old rules no longer protect its interests. India's silver imports jumped 129%, outpacing gold as higher prices reshape trade flows, showing physical demand remains structurally strong despite Western paper price consolidation. Metals trading activity in China is skyrocketing with combined volume. Aluminum, copper, nickel, tin futures jumped 86% month-over-month from January to 78 million lots, 5 times the average monthly volume during the first 11 months of 2025. A massive wave of Chinese retail speculation is behind this rise, with metals becoming the most popular trade discussed on social media as Eastern participants increasingly view physical commodities as protection against currency debasement and geopolitical uncertainty, creating sustained demand that Western paper markets cannot fully suppress through derivative manipulation alone. The Dow-Gold ratio sits near 9.82. A move toward the historical target of 2.5 requires a decline by a factor of 3.93. If the Dow stays flat around 49,500, gold must rise to roughly 19,800. That's a conservative midpoint target, not an attempt to catch perfect tops or bottoms. Chasing extremes increases risk and lowers execution probability. At 19,800 gold and a gold-silver ratio of 19, which reflects past precious metals bull markets, silver projects to around 142. Today's baseline shows gold near 5,042, silver at 77, and a ratio above 65. The move to 19 isn't normalization. It's a swing from one extreme to the other, consistent with historical cycle reversals. Now, consider the mechanics. 9 days before first notice day, 59,000 contracts remain open. Historically, this is rollover season, yet 57% stayed put. That's a major divergence. Recent delivery rates of 10 to 13% versus a long-term 4.9% confirm elevated physical demand. Even at historical averages, 29 million ounces would be required against 90 million registered. Manageable, but tight in the sixth straight year of structural deficit. Bank holidays and Shanghai closures reduce Eastern buying pressure, creating short-term manipulation windows. Meanwhile, dollar shorts sit at 14-year extremes, increasing squeeze risk. China's parallel financial infrastructure adds long-term pressure, but collapse isn't automatic. The pattern is clear. Structural deficits, rising delivery, persistent open interest, and east-west physical divergence all point to shifting probabilities. Markets bottom when forced sellers exhaust supply, not when narratives improve. This isn't destruction. It's a wealth transfer, from paper claims to physical assets that survive resets. Gold, silver, land, productive capacity. Same pattern, same sequence, same outcome. The only question is positioning before recognition becomes universal.